stock market every day, he could be forgiven for wearing a neck brace from the whiplash this week. 1 day up, 2 days down, 2 days back up, and all big moves.
Now, the thing is that for those of you who aren't buying and selling on a daily basis, you probably are wondering what's going on. Check your portfolio, but check your tolerance for risk. That's according to our good friend, certified financial planner Doug Flynn of Flynn Zito Capital Management. Says short-term investors, get out now. If you're not in for the long ride, you may want to just get off the train.
And you're going to tell us how to get off the train like a pro and not like the buy high, sell low crowd that some of us happen to fall into.
That's true, and that's the key. If you need your money soon.
Like you want to buy a house in the next few months.
You know, you've been investing the last 5 years, the market's treated you very well, and so human nature is at the high point, you don't want to get out because you think you're going to keep making money. And then we have this dip over 1,000 points, and you think, you know, should I get out now, but I don't want to. So here's a little chance. You have a little bit of a recovery here to say, you know what, if I need my money in the next couple of years, what's the best way to get out? And you do need to get out because you need this money. It isn't money you're putting away for 20 years. This is your short-term money. So, you know, one of the ways to do that is to not pick any one particular day to get out.
So don't just pull it out.
No, you can. I mean, if you're really need to get out, maybe you pull out half. But, you know, picking today is just totally random.
Same way that you would probably recommend somebody get into the market, not all on one day either. You divide it up over how long?
That's exactly right. Well, you have to know your time frame, but if you know you need your money in a year and a half or so, you know you have to get it into cash, into a money market or savings. So one of the things you can do is a form of reverse dollar cost averaging is one of the terms, or dollar sale averaging is another way to say it. And basically just take the amount of money you need. I think we have an example of if you had $24,000 that you needed to get out in the next year and a half, you can just simply divide that up monthly over the next 12 months. Any mutual fund company or your advisor can divide that, set it up so that 1/12 of that happens every month. And lo and behold, a year from now, you've gotten that money into cash, and you haven't picked today or last week or next month as the time to get out.
You smooth out the ups and downs of the market, and you actually get more of an even number rather than picking the wrong day today.
Right, because it's a mugs game. You're never going to know whether it's picking the bottom of the housing market or the top of the stock market. Where do you park that money?
Well,
because you're not getting any money on interest these days.
No, and you have to be careful with bonds, because although they might lower rates, you know, next time, we're very concerned about what they might have to do to rates later on, and it's an inevitability that at some point rates are going to have to go up, which is probably going to tie into when the dollar will finally recover. It'll be tied into there somewhere.
But this could be a year and a half down the road.
It could be.
2 years.
So if you don't know that, the only place to go is your savings or your money markets, and you have to do that. If you need money in a year, you really should not be in the stock market, and I would hesitate to even be in the bond market with the stuff that's going on right now. So that's kind of the place you have to be, is short-term savings needs to be in cash and money markets.
So if you want to buy a house in the next couple of years, you're waiting out some of these falling home prices, but you know you're going to need to buy a house. What are some of the other things? You've got to keep going to college. Start paying some college bills. You know, what are maybe even healthcare bills? I'm not sure. What are the reasons that would cause you to sort of get out of the market and get liquid?
Well, what's funny about college is people treat college very aggressively, but then they treat their retirement maybe more conservatively, and they don't realize that their kids might be going to school in 5 years, but their retirement is 15 years away. It should be the exact opposite.
Right.
You have to mind the time frame of when you need the money. So it comes back to, if you need the money for the kids in 5 years, you have to set it up appropriately to be available at that time.
The market's been going like this. For the average investor, that's worrisome. They see the 300-point gain, the 200-point loss. What's it really mean? Should the average investor be all that concerned right now?
No, if you're getting in, if you're putting away money for retirement, I mean, personally, myself, money that we're not going to need for a long time, when do you want to buy? When it's 14.2 or when it's 13.2? I mean, these are the times you want to have happen when you're getting in. So getting in, you want to use this volatility to your advantage. It's the buying in at on the ups and downs. But getting out, it's the same thing. Why try to pick the day to get in or out? You can do that by simplifying, by setting it up on an automated basis. You don't have to think about it.
What about if you're looking at your 401k? You know, this is not something you're going to turn liquid necessarily. I mean, it's not money you need right now. I mean, should you be looking at these kinds of principles when you're talking about your retirement that's in your tax-exempt account?
Well, you know, a lot of people did get more aggressive by nature of the market moving very well over the last couple of years. So they might have started with an 80-20 portfolio, and now they're almost all in equities because the market did so well. So you do have to, you know, these are the times to
rebalance.
You have to, you know. As a nation, we don't save enough, period. We don't invest enough of what we save, and we don't diversify enough of what we invest. If you just do those things, save, then invest, and diversify, you've got it all down.
These are such good problems to have. Where to park my money
to buy a house
over the next couple of years. Definitely good problems to have. Doug Flynn, thank you so much. Flynn Zito Capital Management. Always great when you come by. Thanks.
Now, the reason you might need that cash, because you might need to get a gift for a coworker. When you buy a coworker a gift that comes in small, medium, or large, you may be doing them and yourself more harm than good. We've got office gift-giving do's and don'ts that I am certainly going to stay tuned for, so you should too. Stay with us.